Good afternoon, it's Christian Thwaites of Brown Janikowski, the afternoon of December 7th. It's obviously a day of infamy, with the 75th anniversary of that, so something to remember as we approach the holiday season. Markets have been continuing their uphill climb, which they've been pretty much doing without a stop since the Trump election. So three quick things this week, but one of them is more important in the long term. So three quick things are the S&P reached another record high this week, so it's up nearly 10% on the year, and small company stocks up nearly 27% this year, also at an all-time high. So many of our clients have been invested in those, and we're glad to see those returns. The story there, of course, is that this inflation, reinvestment, pump priming, fiscal stimulus, deregulation, re-regulation, creating jobs and keeping jobs onshore, this kind of theme, which is sort of going on multiple fronts, continues to buoy the stock market. Second point is the dollar continues to be very strong. Now, a strong stock market and a strong dollar are not incompatible with each other. People feel that strong dollar will erode some US companies' foreign earnings. Not so necessarily. We continue to see that strong dollar right now, especially as the yen and the euro are keeping their rates relatively low. So we'll be keeping an eye on that, but it does mean that for a US investor, some of the overseas returns are going to be less than they would otherwise be. But the third chart is an important one, and I'd like to show this right behind me here. What we show here is over 60 years of the 10-year interest rate on government bonds and inflation. Now, people have been talking about, is this the end of this secular bull market in bonds, which is this blue line from the tip right up here in about 1980, pretty much through to today, as this goes a downward line when rates were about 15% up here to about 2.5 now. Is it the end? And then the other line is inflation. And what's much more damaging to a bond investor is this line, inflation, because that will erode the real rates of return which you get from a fixed yield on the 10-year treasury. So we think people's concerns about the end of the bull market in bonds are misplaced. You have to really worry about inflation. So where are we on inflation? Well, you can see that this number dropped precipitously in the early 80s and has been pretty much at the 2% line ever since, with some changes up and down depending on oil's going up, oil's going down, or there's potential squeeze in the economy. But essentially inflation has been very well managed between about this 1.5% rate, today it's about 1.6, and about 2.5–3%. The Fed simply won't let inflation take off. And this is 35 years almost of the Fed keeping control of this. And the last part of this chart is that if you look down at the bottom, every time this blue line is above the black zero, that's a real positive rate of return on your bonds. It's beating inflation, which is what we want them to do. And you can see that's been pretty much unbroken since about 1980. And even before that, it was more the norm that they provided a real rate of return. Where are we today? If you look on the right-hand side, we're at about 0.8. This is 1.8 because it takes, it's a number from the end of the month, whereas things have changed in the last couple of weeks. And we think that's lower than it has been. The average is about 2%, 2.5%, but it's certainly not going to go much lower than this. So we think just stay calm with the bonds. We like where bonds are right now. They're not yielding as much as they did, either in nominal, in real terms as they used to. But as rates back up to about 2.4, 2.5, we think some of the weakness in the bond markets is probably mostly done in the short term. Thank you very much.